Hello and welcome to our webinar today. We're excited to have you join all of us. Want to let you know that today we're going to be covering some topics that all of you might have questions about, or maybe things that we've thought of as a group that would be good planning ideas and tips for you. First, I want to let you know a little bit about Boulay. We've been a firm for over 85 years, lots of different professional services that we provide. And one of the areas that we have is wealth management. And so our group today will be from wealth management, speaking into you and your lives and hopefully helping you out. The four colleagues of mine that are going to join us today are John Melander, Joe Bloodgood, Nathan Faith, and Laura Stenzel. And collectively, we have over 80 years of experience, multiple different backgrounds as far as tax planning, investments, estate planning, and 401k. So lots of different ideas and a great group that's going to come to you today to share their opinions, perspective, and thoughts for you guys as far as what you could be doing during this strange time that we're in. So the first step that we're going to talk about is the market. So I'm going to turn it over to my colleague, John, and ask him, with the economy, where it's at during this pandemic time.
Well, thanks, Heather. Like Heather said, my name is John Melander. I'm a partner here at Boulay Financial Advisors. Currently manages just under $2 billion in assets under care. And we have a team of about 30 colleagues that I consider the best in the business. And I think that'll show through here as we go through the slides today. So with that, let's talk a little bit about the economy. So where have we been so far? What's happened? Obviously, you've seen the news and lots of things going on. So back in February, everything was looking fairly rosy, so to speak. The markets were hitting new highs, and within a short amount of time, all of a sudden, we see quite a bit happen when the COVID-19 hit and started spreading through not just the U.S., but other parts of the world as well. So what's happened with the economy? Unemployment rates have hit the highest since the Great Depression. Leading economic indicators plunged the most ever on record. Global manufacturing is contracting and supply chains disrupted as states have gone into shutdown mode and made people stay home from their jobs. Earnings have been revised down at a record rate. So right now, if you're looking at the news and just reading the headlines, obviously things are looking fairly grim right now. But the other part of what we look at is not just the economy, but what is the market doing? And they're not exactly the same, although they tend to move in concert with each other. So if we're talking about the markets in general, you have markets being, the S&P 500 index and some of the other popular markets that are out there, but they tend to be a leading indicator. And one thing that the markets don't like is uncertainty. And so as we hit the end of February and the economic shutdown started to happen, the market actually plunged about 34% from the peak in February to its trough. And of course, like I said, there was a lot of uncertainty at the time. How was the shutdowns going to affect the economy? And the stock market was really going through a period of time where we saw constant selling, and there wasn't much relief for that. As a matter of fact, we did see a decline of 20% in 15 trading days, which was the fastest in history. So those that are following the stock market, it was a period of time when things were down almost every day. So how has the crash affected not just the U.S., but every other stock market in the world? And actually some of the international markets were affected even more than the U.S. markets. And since then, though, the S&P has rallied from that low back in March to rallying actually more than 40% right now. So why is that? Why are we seeing all the bad news? The economy is being shut down basically and slowly restarting. The markets have been went through a period of time, not just on stocks, but also bonds were everybody was looking for liquidity. And now we've seen the markets come back quite a bit. And we'll talk to that in a second here, but what can we expect going forward? Well, one thing that you probably can expect is volatility will return, and on a daily basis, both up and down. And so what are the things that we're kind of recommending? Well, some of my colleagues will go through some of the planning ideas, but one of the things that we've been stressing with clients is, because there's so much uncertainty, is that they should keep any cash needs that they have liquid and not try to time the market one way or another. So 6 to 12 months maybe of cash needs set aside to take care of those things that you need to use that cash for immediately. Watch for signs of economic life early in 2021. And so if you're hearing some of the economists out there, that's kind of where they're saying that we'll start seeing things go back to whatever the new normal would be. And now we're already seeing signs of some economic activity as states are opening up their economies and letting people go back to work. But it's not going to get up to full speed for quite a while, in my opinion. And like I said earlier, markets tend to look forward, and so we've seen the market come back here quite a bit from those lows, because it is looking out 6 to 12 to 18 months down the road to say, what is the economy going to look like then? And if you're looking at the big picture, what you're really buying with stocks when you buy into the equity markets is discounted future earnings. And in the next 20 years, when we're looking back at this time, it's really going to be a small part of that discounted earnings that you're actually buying of those companies. Certainly, there's going to be companies that have suffered that don't quite make it back to where they were before everything that happened, but there's certainly been some winners as well, and those that are coming out of this situation could be a lot stronger because of it. Stocks could be actually a long-term bargain right now, even though the markets have recovered quite a bit from their lows. Because Treasury rates are so low right now, we've got this chart here shows Treasury rates versus the yield on the S&P 500 is the best ratio since the 1940s. So the yield is somewhere around 1.9 to 2% on the S&P right now, and so with 10-year Treasuries at 0.75% and short-term Treasuries near zero, I think investors are looking at stocks and saying, I know there's going to be volatility, but if I'm looking out 2 years, where would I rather park my money? If you put it into stocks, you're getting that dividend yield in the meantime, as long as you're willing to ride out those ups and downs. And so I think that's part of why the market has come back quite a bit. I think people are realizing that there's some pretty good bargains out there, but be cautious. I think there's going to be some continued volatility going forward, and keep your wits about yourself when you're making your investment decisions, and stay invested with those long-term assets and you'll get rewarded down the road. So with that, I think I'll turn this back over to Heather, and I'll come back on in just a little bit.
Thank you, John. That was great perspective on the investments. I think it's important for clients to remain invested, and you gave some great insight into what they should keep in mind. Joe, is there anything that you can share with our clients as far as past healthcare crises and what that's looked like in history?
Yeah, thank you, Heather, and thank you, John. That was great information. I wanted to spend just a moment hopefully providing some perspective and talking a little bit about behavioral finance. We know from the research that positive outcomes are really a function of two different things. They're a function of asset allocation, or where we put our money, and they're a function of investor behavior, or how we react when things don't go according to plan. One of the hardest things for folks is to sort of see beyond what's right in front of them. And COVID-19 has been a unique situation, no doubt. I'm sure there's not one person on the call that hasn't been affected in some shape, form, or fashion from what we're currently going through. That being said, markets tend to be quite resilient. Even if we look just over the past 20 or so years, we can see a timeline of different sort of global viral outbreaks that have happened over that period of time. Now, many of these probably aren't going to resonate like COVID just because many of them maybe didn't happen here in the United States. But that being said, you can see how a global market index has responded to different outbreaks over the past number of years. One of the things we get questions about is, how should we expect this? Many times we look in the past and we see, hey, on average, 7 out of every 10 years, or even a little more than that, tend to be positive years in the market. So we look at where we started on January 1st, where we found ourselves at the end of the year, and 7 out of 10 times we made money. What people often forget is that sort of the road along the way tends to be a little bumpier than we may remember. And so for some perspective, I think it's always good for people to take a step back and understand kind of what is normal course for the markets. The chart you see here, you can see how frequently this, certain sizes of declines tend to happen. And so if we just talk about a 5% move within the market, so from a high point, drops down, you hit at least 5%, something like that happens 3 times during the year typically. So I go back and I remind you, 7 out of 10 years tend to be positive, but on average, we're seeing 5% declines happen 3 times within the year. And you can see there, this chart is even a little bit dated because we clearly had something much more than that just earlier this year. You look at a 10% decline, that's the average 10% decline, that happens at least once a year on average. And you stretch it out and you look at 15% declines or 20% declines. And what you find is they're not all that unique. And they're not all that memorable once you get past them. But when we're in the middle of them, we tend to get pretty wrapped up in them. And it's easy to convince ourselves that maybe this is the big one and this is the time that something new is about to happen, or this time it is different, so to speak. I think it's really important that we think about what are some things we can do. One of the hardest things about investing is the truth that you have an opportunity to positively affect your situation or your account much more when things are tough, right? So when we went in mid to late February through mid to late March, when the market lost 1/3 of its value, that became a golden opportunity for a lot of different solutions and strategies that can ultimately help the investor. And so just real briefly, I'll just mention a couple things. There's a list of natural biases here. I'm not going to necessarily go through there. I want to focus on the strategies. And the first thing I would say is just to expect the unexpected. And I think we've learned that over the last few months. Know that the market on average will move down 10% in an ordinary year. How can you combat that? Well, number one, you can strategically make investments. You can do it on a schedule where you're putting money to work the same day of every month. You're putting money to work, rain or shine, whether it feels good or bad, and just sort of taking the guesswork out of it when you think the market's high and when you think it's low. Another thing that's really helpful, I think, for our clients is to tie your results not to what the market did. So when you open your statement or you look online, it's very easy to get a quick snapshot of where are you year to date. I think it's much more helpful, though, to see your performance in light of your overall goals and your financial plan. And so for many of our clients, they have specific financial goals around retirement or unwinding themselves from a business or putting kids through college or paying for an outside investment, whatever the case may be. I think it's important to see your investment progress in light of your progress towards your financial goal. And then the last couple of things I would say is just, it's so much easier to make a plan when you're unemotional. So when times are normal, quote unquote, or when things feel stable or good, that's a great time to make an investment schedule or a financial plan. that you can refer back to that living document or that software that's being used to show you the direction that you're going, sort of rain or shine, whether things are good or bad. So I would just point out a few of those things. The last thing I'll share with you is just a really simple illustration that I've always found helpful as a good reminder. It says how to outperform 99% of your neighbors, and it's really, like I mentioned earlier, it's a combination of good investments and great behavior, and that, like it says there, that'll do the trick.
Thanks, Joe, for talking to us a little bit about our, behavior and natural emotions that we do as humans. So, coming kind of like on top of that a little bit, Nathan, I know personally, and I know sometimes our clients, when they have personal situations go on or a bigger scale like economies like there is now, all of a sudden things happen. We have that pit in our stomach. We're wondering, well, what are some options that we can do, or what are some lines of defense that we can do to help our situation, to make us feel better and not worry about keeping the lights on, or how are you going to pay for things? Do you have some tips that clients can be considering during this time?
Yeah, thanks, Heather. Actually, John and Joe both alluded to this concept of lines of defense. And all it is protecting your nest egg, your financial plan, that is your long-term plan, but what to do when life throws you curveballs, personally or economically. And so where we start is where John started. Our first line of defense is always cash. We recommend that all of our clients have cash at the ready for day-to-day living expenses, but also for that occasional surprise that comes along. The amount can change from person to person, but typically we recommend that clients have at least 6 months worth of expenses saved and at the ready. What are those expenses? Those are the expenses that did not go away for you back in March and April. So you think of your mortgage bill, utilities, groceries, those stuck around, where other expenses such as going out to eat or traveling, those went away. So we want you to have 6 months worth of those essential expenses in cash at the ready. But you don't need to have enough cash for that once in a generation event or flood that comes along, because it wouldn't be put to work. It would require you to have to save a lot more than you actually need. But most of us who are disciplined with our planning have more backups, more lines of defense than we really think we may have. And the next major line of defense has to do with our homes. So over time, as we pay down our mortgages and our homes increase in value, we own more of what our home is worth and the bank owns less. That difference is called equity, really ownership. And with very little cost and some effort, we can set up a line of credit, really access to cash that's within our home with the bank. And once we own more than 20% of our home, we can start to create that line of defense. Home equity lines of credit really come in handy when we experience life surprises, whether that be an unexpected layoff, a disability, an economic event like we're experiencing. And accessing that line of credit costs us nothing until we actually draw upon it. But once we do, all we pay is some interest to the bank, which is a lot less costly than if we otherwise would sell investments that we normally would not want to sell. And that leads us to the largest line of defense that we typically have, being our nest egg. So by and large, we all own investments in various accounts, namely taxable accounts. Those accounts don't have restrictions based off of age and are accessible. But as we near retirement, we tend to have investments that are meant to hold up well in environments like this, or be at the ready when life throws us a surprise. So with retirees, typically we see that they have a fourth to a third of their portfolio invested in very safe investments, namely their bond allocation. That's enough to cover 4 to 8 years worth of expenses and get any one of us through even some of the deepest recessions without having to sell stocks or pull money from other sources that we'd rather not have to pull from. So what do we do if we own very few bonds within our portfolio, or bonds are down in value more than we like? Because even bonds can be down 5 to 20% temporarily for weeks or months at a time. There's a line of defense that many of us have that we don't even know actually exists, which is essentially a line of credit against our investments and taxable accounts. Now, moderation is the key, but if we would rather not sell any investments in our portfolios, we can temporarily borrow against them, pay a little bit more in interest than we would on a home equity line of credit or a mortgage, but it's worth the cost of admission versus having to sell investments that are down significantly. Now, from there, we work our way to our retirement accounts. Traditionally, our retirement accounts have restrictions. They're meant for retirement, and they limit how much, if anything, we can draw from those accounts until we're at or near retirement, specifically age 59.5. However, many of us have 401k plans, and if those plans allow for it, we can borrow against those accounts and really pay ourselves back the interest. Now, we don't recommend that folks use this line of defense unless it's absolutely necessary. But if worse comes to worse, it's a lot better than permanently removing money from accounts that cannot be replaced and result in high taxes and penalties. Specifically, a law was recently passed that allows each of us individually to borrow up to $100,000 from our 401ks to get us through this experience, if need be. That leads us to a very close cousin of our 401ks, our individual retirement accounts, those accounts that we hold outside of our work-based plans. Now, those accounts don't technically allow for loans, but again, a new law that was passed a couple months ago effectively does. So we now can withdraw up to $100,000 per individual and not have to pay any taxes or penalties on those dollars this year. And if we repay ourselves into those accounts evenly over the next 3 years, so 2021 through 2023, we don't owe any taxes at all. It's one of the largest assets that we have, but many of us don't really know or see that it exists, is our Social Security benefit. For many of us, our Social Security benefit is worth the same as having hundreds of thousands of dollars in our IRAs or our 401ks. Now, we typically recommend that our clients wait to claim their Social Security benefit for as long as they can afford to draw their spending or their expenses from their other accounts, because we get rewarded for waiting on claiming our Social Security benefits. But a unique strategy exists for when life throws us a surprise, or if the global economy throws us a surprise. Social Security is completely agnostic or uncorrelated to what any investment is really doing, whether it's bonds or stocks. There's a unique strategy in which, if we would rather not draw from our investments or even our checking account, we can temporarily turn on our Social Security benefit to start a paycheck into our checking account to cover our first dollars in our budget. And if we turn off that benefit within a year's time, we can actually write a check back to the Social Security Administration, and it's like it never happened in the first place. If we wait longer than a year, once we reach what's called full retirement age, which is usually about age 66, we can then suspend or turn off our Social Security benefit. And if we suspend our benefit, we can then start to receive our annual rewards for waiting of 6.25% to 8% per year for the rest of our lives. Then we move on to our health savings accounts. We leave these for nearly the end because health savings accounts are the absolute best place to have our money grow for all the tax benefits that come with them. Typically, we recommend that our clients leave their HSA dollars alone and invest them to grow. and use their cash in their checking and savings accounts to pay ongoing healthcare expenses. However, a little known fact is if we don't reimburse ourselves from our health savings accounts for those qualified medical expenses, if life throws us a curveball, we can actually write ourselves a check from our health savings account for our previous healthcare expenses, which can add up to be a lot over time and can be a good source to draw from in a pinch that is penalty and tax-free. And then finally, our Roth IRAs. These are wonderful accounts. I hold them near and dear to my heart. But whether we're young or old, our Roth IRAs are a wonderful line of defense for us because, believe it or not, all of our contributions to our Roths are completely tax-free and penalty-free for us to withdraw when we need them, no matter what, at any time. And if we're over the age of 59 and a half, we typically can draw any growth from those accounts tax-free as well. But because we can experience decades of tax-free growth, unless we need to or it fits well into our normal planning, we'd rather leave those Roth accounts to grow going forward. So know that these lines of defense are not necessarily in order, but there's also many, many more options for us to think about when life throws us a curveball than necessarily selling out of our investments that have been beaten down. So with that, I'll pass the baton back to Heather.
Thank you, Nathan, for sharing different ideas that our clients could pursue as far as options during this time to think about if they have cash needs. And we always obviously recommend, consulting their advisor if they want to know like which one's the best situation for them. So we're going to go back to John, and I have a question for him as far as just some basic investing fundamentals. How does asset allocation help with the volatility of a portfolio?
Well, thanks, Heather. I think Nathan touched on it here when he talked about having that bond allocation. And this next slide that we're going to look at here just shows what volatility looks like over time. So over different time frames here, this slide is really showing you what that volatility looks like. And what you'll notice in the 1 year time frames, the green bar represents the S&P 500. Blue is bonds, and then the gray one is 50-50 mix. And of course, there's a lot of other asset classes that we would put into one of our clients' portfolios, but for just simplification purposes, we wanted to show you what that looks like over time. So in a 1 year time frame, with stocks, there's obviously quite a bit of volatility, and we've experienced that both on the upside and the downside over the last couple of years, and most recently the downside. And as you can see here, if you're in 100% bonds, that downside risk in a 1 year time frame going back over the last 50 years is 8%. Now, people sometimes say, well, bonds are safe. I can't lose money in bonds, and that's not true. You can lose money in bonds. And you can see that illustrated here in the range of returns. And then you have the 50-50 portfolio, where you have stocks and bonds mixed. And Nathan touched on it as a way to pay some expenses. But the other thing that we use bonds for is to rebalance. And so what we're doing here is if we're mixing bonds and other different types of asset classes, what you get is an opportunity to move out of something that's probably held up or did well in a down market, and then reinvest those dollars back over into the asset classes that haven't done well. But as you notice here over time, the 5 year and 10 year rolling periods, and then of course now the 20 year rolling period on the far right, stocks actually become a lot less volatile. And you can see that the range of returns over 20 year time frames, the bottom return in that time frame, 20 year time frames, is a 6% upside. So in reality, worst case scenario over 20 years, if you were 100% stocks, you're still going to get 6%. But if you notice in the 50-50 portfolio, you're actually getting just about as much in the worst case scenario. You're giving up a little bit of upside in that situation, but you're protecting on the downside. And what this chart doesn't illustrate is that rebalancing that I touched on. The next thing I wanted to talk about, and this is a little bit of a busy slide, but why is asset allocation important when we're going through times like we just went through? And this top of the chart, and I know it's hard to read, but shows the great financial crisis and what happened. In this case, we have a 40-60 stock to bond ratio in the dark blue bands. The light blue, it represents a 60-40 stock and bond allocation, and then the green is just 100% S&P. So starting back in October of 07, when the market hit its highs, it took almost a little over 2 years for that 40-60 portfolio to get back to where it was. So that's not too bad of a time frame if you're thinking about all that we went through during that time. A 60-40 mix took an extra year to get back to that level that it started at back in October of 07. 100% stocks, now that took actually a lot longer. So that you had to wait till March of 2012 before you got back to 100% of where you started that time frame. So again, this doesn't illustrate the effects of being able to rebalance over time and what we've done and would have done back in the great financial crisis is taken advantage of some of those low prices in stocks and probably come out a lot rosier and sooner than maybe that March of 2012 mark if you're 100% stocks. The other thing I wanted to illustrate here is on the bottom of that chart is different asset classes and how they've done over the last 20 years through the end of last year. You can see on the far left, REITs did really well, then gold, S&P 500, and then we've got the portfolio mixes. On the far right, it shows what inflation did over the last 20 years. But if you notice, right next to that inflation in the orange bar shows what the average investor did. And Joe touched on it a little bit with his talk on, behavioral finance and how being prudent with your plan and sticking to it can really help out. And this shows that the average investor, even though we had a really good market during this time frame and a lot of different asset classes, the average investor barely did better than what the inflation rate was. And why is that? I think it's because they didn't have a plan going into any sort of crisis and tends to buy at the wrong time and sell at the wrong time. So having a financial advisor that's giving you good advice and making sure that you have that financial plan that you're sticking to, making sure you have those lines of defense lined up before you actually need them, and then being able to stick to your plan and then rebalance your portfolio in an asset allocation that makes sense for you. So I think this chart really on the bottom says a lot and what the value of investment advice and having a financial plan really means to people over time, because when you start adding these percentages year over year over time, it becomes a pretty big dollar amount. So my suggestion is make sure you have that plan, make sure you have those lines of defense. Don't get emotional about the markets and stick to that plan over the long term. With that, I'll turn it back to Heather, and we'll talk a little bit more about asset allocation and other topics.
So as John spoke on with asset allocation, how important that is for your portfolio, I know that personally, and I'm sure, and we hear it from clients, I'm sure, all of us would agree that, of course, we want our investments to earn money. And so people like to talk about, oh, what's the latest and greatest, stock to pick, try and potentially earn, your way to millions and millions of dollars. But outside of that, what are investors able to do to keep more of their investments as far as their earnings? Nathan, are there things that you would suggest that clients could consider doing, whether it's during times like now or just in general?
There are a number of things to think about. The phrase I think about most when it comes to how we invest our money is Ben Franklin's statement of a penny saved is a penny earned. When we think about investing, many of us look at investing as being asset allocation. That's that penny earned. It took me many, many years to figure out what Ben Franklin said and what it really meant. But the penny saved part is what we'll be really talking through for the next few minutes. So asset allocation is how we invest our money. That's putting it to work. And by and large, the mix that we choose dictates how our money will work and grow for us over time. So if we're invested 100% in bonds, we can expect to earn less than a portfolio that's, say, half in bonds, half in stocks, which would earn less than a portfolio that's all stocks over the long term. Now, how do we keep more of what we earn? That's that methodology of working smarter versus harder. And that's where knowing what we own and where our largest expenses on those investments come from. And the biggest expense that we have in our wealth typically are the income taxes that we pay off of the dollars that we earn. So high level, the income that we earn falls into one of two buckets. We can have ordinary income or qualified income. And what's the difference between the two? Well, in front of you is a graphic that takes a look at our tax system and how we're taxed on ordinary income. So at the low end, we're taxed at 10%, but as our income rises, and this is a look at the federal tax table for a married couple, we get taxed at a higher and higher rate, up to a top tax bracket of 37%. What is ordinary income? Ordinary income is the most common type of income. So we think of our salaries that we earn, our pension and Social Security checks that we receive in retirement, and also dollars that we withdraw from our retirement accounts once we are in retirement. But what many of us don't realize is that the types of investments that we own are also taxed in this or the next bucket. Specifically, assets that produce ordinary income are the dollars that we own in our checking, savings, and brokerage accounts that are invested in cash or bonds. Why is that important? Because there's another type of income that is always taxed at a lower rate than ordinary income. Qualified income applies to a very narrow type of income that we can earn within our taxable investment accounts, namely any profits that we earn. So if we buy at one price and sell at a higher price, those are called gains. And if we own them long enough, they fall into this qualified bucket, namely any investments that we own for a year or more. Then the other type of income that's considered qualified and falls into this bucket are any dividends that we earn from underlying stock investments. And what's important to note is at the low end, this type of income is completely tax-free federally. And at the high end, the tax rate's 20%. Now what we do with our planning is we compare where our client's income is on the left-hand side of the column relative to the right-hand side of the column, because it matters where we place, aka locate, those investments, which allows you to keep more of what you earn. So what do we look at with asset location beyond the investments themselves? It's the different account types that we can own. So high level, we can own three types of accounts. Investments go into these three buckets. The first being the always taxable bucket on the left. That's the most common. That's what we call the blue types of accounts. That's where it matters if you place bonds in that type of account. The income is taxed in that first column, the ordinary income, or if we own stocks in that type of account. Year by year, that income is then taxed in the second column, qualified income. But that green account in the middle, those are our 401ks and IRAs. Those accounts push the tax bills that we pay out into the future. It's called tax deferral. What's unusual about these accounts, though, is they mutate or transform all the growth and income from any type of investment to ordinary income upon us withdrawing money from those accounts. Thus, every dollar that we withdraw from our 401ks and IRAs falls into that first column that we saw, the ordinary income column. So it's important to know how those dollars are taxed when we distribute them. In the same vein, the third type of account, those are accounts that are never taxed again. We pay that tax bill up front when we contribute or convert money into those accounts. The most common term we use for those are Roth accounts. Those accounts also mutate or transform the very nature of the investments that are held within them, so that all growth and income from those investments comes out completely tax-free whenever we choose to withdraw from those accounts. When we combine the types of investments we own into the types of accounts that we have, we can zero in on the most effective way to locate our investments within our portfolio. So traditionally, we start by looking at dollars that we contribute into our IRAs. And what we like to do is we like to mirror the taxability of our investments with the taxability of the account. And so we typically start with our bond investments going into our IRAs, because bonds are taxed in that first column, ordinary income, as well as our distributions are taxed as ordinary income out of our IRAs. And they typically tend not to grow much over time. Each year they distribute their income and there's not much in the way of growth. We then fill up the Roth with the investments that we feel have the highest likelihood or probability of growing the most over time. And we fill up our Roth accounts until we run out of Roth dollars with those investments. So if you think of the experience we had in March of this year, there are many types of investments within our portfolios, such as value stocks, whether they be US based or internationally, that were well positioned for long-term growth over the years ahead. And that's where we would locate or relocate those investments to be well positioned for tax-free growth going forward. And then finally, whatever remains within our portfolios falls into the remaining bucket, the taxable income bucket. By locating our investments in an optimal way, many of our clients are able to keep a fourth to a third more of their returns over the long term, just by being cognizant of what they own and where they own it. But what if we don't necessarily have the right mix? At least not now. There are things we can do to align how our investments are allocated with how our accounts are also located. So here's an example of what we call asset migration. So if a client or anyone has an investment allocation that fits well within their investment plan and fits well with their risk tolerance, meaning they can sleep at night, we want to stick with it. So without changing how they're allocated, we move on to how their account types are located and diversified. So many folks have a mix that's different from the chart you see above, meaning that they have more in, say, the forever taxable accounts than what we'd like in order to shelter that ordinary income from their bond exposure. Through several different strategies, we can help identify the right mix and how to get there over time and migrate our wealth into a mix that is more efficient, meaning you get to keep more of what you earn and Uncle Sam gets less. What are some of those strategies? If we want to increase what's in the tax deferred bucket, we oftentimes use what's called an investment-only variable annuity to literally transfer as much as is required from the blue bucket to the green bucket. And if we want to expand what's in the tax-free bucket from the green bucket, we perform annual strategic Roth conversions. And over time, these strategies can save you and your loved ones hundreds of thousands or millions of dollars over the course of your lives. So with that, I'll hand it off to Heather.
Now that we've heard from Nathan as far as some different strategies to help retain more of our investments, I'm going to ask Laura if she could give us kind of an overview on some of the things that we need to consider from a tax perspective.
Thanks, Heather. So kind of looking at the changes that occurred with the CARES Act and the changes in the tax law that happened in 2018, there's a lot of planning opportunities that can be taken into perspective. So here you can see the two differences in the tax law prior to the 2018 changes and now reflecting the next several years up through 2025 with the CARES Act. The changes in the tax laws here that you can really see there's opportunities for individuals to leverage either taking more income during a year or kind of bringing down their income depending where they sit at with their marginal tax rates. So for example, if we looked at prior to the 2018 tax law changes, someone might have been sitting around 155,000 AGI and they would have been around the 25% marginal tax rate versus if you shift over to the right-hand side, you could see someone with a similar income level would be roughly in the 22% bracket, and the 24% bracket is much higher up. So someone could leverage and take out more income or bring in more income in that year. And a couple different ways that you can go about that Nate talked about was doing Roth conversions. So first off, for 2020, there's been a law that came into effect for 2020 that suspended all required minimum distributions for the year. So you're not required to take a required minimum distribution from your IRA for 2020. However, this does present a planning opportunity for individuals to actually do a Roth conversion. So taking money from their IRA and moving that to a Roth account, which then from that point, it would actually grow tax-free. So they would have tax on that account now, but the future growth of that can grow tax-free. So for example, if someone were in that case where they had the 155,000 of AGI, they were sitting at a 22% marginal tax rate, where we could soak up that tax rate all the way up to right before they kind of make the huge leap into the 32%. So someone could do roughly around a $200,000 Roth conversion without having a huge tax impact. Other times where Roth conversions, not just in the year of 2020, are impactful is in years where an individual has just retired and their marginal tax rates are a lot lower. Those are years where it's a good opportunity to start moving funds from those taxable accounts, your taxable IRA, into a Roth account to take that tax out now and then have that account again grow tax-free. And additionally, then once the money is in your Roth account, you don't have the requirement to take out those required minimum distributions every year. You can pick and choose when you want to take out those funds, depending on your cash situation or what funds you need at that time. So it gives you a lot more planning flexibility and allows you to actually take control of your account and even manage taxes in that way as well. So with the Roth conversions, there's another planning opportunity aside from increasing your taxable income is if an individual is charitably inclined, the opportunity is to either lump your charitable contributions together to get a maximum impact within 1 year, or another opportunity depending on if an individual has a lot of stocks and bonds that have appreciated greatly, you can actually set up what's called a donor advised fund. And with that donor advised fund, you can contribute through cash or using stocks and bonds. And the big proponent of using your stocks and bonds in those accounts is because when you contribute any appreciated stock into that account, you would get immediate deduction on your tax return for that charitable contribution at the fair market value. And then you can choose future years. You don't have to immediately choose what charity you want to contribute that money to. You can choose in the next year or over to the next 5 years to kind of divvy out those contributions. And the big proponent about that is once you've moved those money into the donor advised fund, again, that can grow and it can continue to increase in value, which in essence actually increases the end contribution you can make to a charity. Because if you were to sell your stocks and use that money to then give cash to a charity, you would actually have to pay your capital gains tax on that. Referencing back to the slide that Nate showed before, where it talks about there's the 2 different incomes, ordinary and capital gain. You would have to pay capital gains tax on that, and then that would lower, in essence, the amount of money you have left over to give to a charity. So you're actually kind of having more money to give to that charity, and then you're stepping out from having to pay that capital gains tax as well. So by contributing these appreciated stocks and funds into the donor advised fund, you're skipping out on the capital gains tax that you would have here on the right-hand side. So it could vary from 0 to 20%, where you would normally have to pay that if you just took the proceeds from the sale of your stock and then contributed that to the charity that you're using. You wouldn't have to pay that. So now you can contribute the full amount into the donor advised fund, and then you're contributing more money eventually to your charity. And again, that grows tax-free from the point that it goes into the donor advised fund. So by coupling those 2 strategies together, we can either move the target up or down when someone's at a lower marginal tax rate. If they're down in the 22%, we might move them up all the way to the top of the bracket of the 24%, or vice versa. We can kind of leverage both of those and move them around depending on what the individual situation is.
Thank you, Laura, for sharing with the group that's listening today different strategies when it comes to tax planning. We want to thank all of you for listening to us today. We are happy and excited to share with you our ideas, insight. We want you to know that if you want to reach out to any of us, we'd be happy to talk to you. If you have a current connection here at Boulay Financial Advisors, definitely reach out to them. Otherwise, our contact information is on this page. Otherwise, you could also go to our website, which is www.boulaygroup.com. I want to tell you one of our value adds to clients is the fact that not only can we help you with your wealth management, we can also help you with taxes. We can help you out with your estate planning. So such a great, unique opportunity that we do to serve clients. So we would love to get to know you. Give us a chance. We have a great tool, Wealth Nav, that we use with clients that clients are very happy and it's well received. So with that, I wanted to say that we hope you all are staying safe, you're staying healthy, and have a great rest of your day.